Hi, everyone. I'm going to talk through the first portion of chapter 14. I think I'll get us through um, the first four objectives covered in chapter 14, and then I'll conclude this lecture and I'll do another lecture in another couple days on the last half of the chapter, which will cover actual taxation of simple trusts and grantor trusts, as well as the administration of, compliance requirements and administration of trusts and estates. This chapter covers both trusts, income taxation of both trusts and estates. And good for you to know that Subchapter J of your Internal Revenue Code, sections 641 through 692, cover the tax rules applicable to both estates and trusts. They are both considered to be entities called fiduciary entities. And that's because a fiduciary is someone who takes care of the property in that entity. And so they are called fiduciary entities because, as we'll discuss, each one, both trusts and estates, have a fiduciary, someone who takes care of the property within the trust or within the estate. One of the main differences between trusts and estates is that whereas a trust can be created at any time during the life of the transferor of the assets into the trust, or after death of the transferor, an estate entity, if you will, is only formed once somebody dies. So we would not refer to my property as my estate until I die. My property is my property, and it might be held in trust for me or for my beneficiaries. And there are certain tax benefits and also legal benefits to doing so, to holding your property within a trust. But I would not refer to my property as my estate until I die. Here's a nice pictorial of a trust. So the trust is pictured in an org chart as a triangle, typically, and that's because it's a flow-through entity. It's actually a conduit entity, like a partnership is. The donor up here in the left-hand corner, pictured it as a rectangle, is the transferor of property into the trust. They're the ones who make the trust, and they are the ones who contribute money or other property into the trust. The trustee is someone who's named by the transferor/donor to administer the trust, to take care of it, to be the fiduciary of that trust. Often that person could be an individual. It could be a bank. With grantor trusts, you typically often have a bank listed as the trustee. So it could be a number of different types of entities or individuals acting as the trustee. And then the beneficiary or beneficiaries they could be either individuals or they could be organizations like charities. The beneficiaries are the ones who stand to benefit from the distribution of the property out of the trust someday. It could either happen yearly or monthly, or it could happen after death of the donor. but in any case, the beneficiaries are the ones who stand to benefit from the distribution. Conversely, an estate, the person putting in the money into the estate is the decedent, the person who has died. And upon the owner's death, the property of the decedent is called his estate. And as we learned in the last chapter, in chapter 13, we have to determine what's in the gross estate and what's in the net estate, and then what can be subtracted from the net estate to come up with our estate tax base, because we need to know how to tax the estate on the estate's tax return. Or we need to know, in fact, if we're even going to need to file a tax return. So, and then the fiduciary of the estate is called the executor. That's the person who would carry out the terms of the will, or it could be an estate administrator if the person dies intestate, i.e. without a will. And then you have beneficiaries, the individuals or the organizations that stand to benefit from the distribution of the property out of the state. And once this estate is settled, and all of the taxes have been paid and debts have been paid and so forth and so on, then the beneficiaries are distributed the property out of the estate in accordance with the provisions of the will or the provisions of the trust that some or all of the property sits in. Now, there are many reasons why a trust might be created. It could be created for tax reasons, or it could be created for non-tax reasons. One of the reasons historically for creating trusts was an irrevocable trust would be created whereby the grantor is not allowed to require the trustee to return the assets back to the owner. And what came of that was an ability for some of the income from the trust, some or all of it, to be taxed to someone, i.e. The beneficiary, at a lower tax rate than the marginal tax rate of the grantor, the transferor of the trust. And so that was called income splitting. And that enabled a grantor to essentially reduce his tax burden by putting some of the income, some of his property or his income into a trust, avoiding income tax at his rates on that trust property, and then having that property be distributed to a beneficiary in a much lower marginal tax rate, someone who makes a lot less money, and it would, typically be someone in the family, so that they could then essentially as a family pay less tax than they would if the grantor was just holding the assets outright. Another tax reason for creating a trust could be to minimize your estate tax. And as we learned in chapter 13, as long as there's no right by the grantor or the transferor to the income in the trust, or to any of the property that's transferred to the trust or any income from the trust, then upon the death of the grantor, the transferor, that income would not be includable in his estate. And so because he's got the income coming out of a trust, he escapes taxation, estate taxation. So that would be another tax reason for creating a trust. A couple of non-tax reasons would be, one, sometimes trusts are set up to protect the assets within the trust from creditors. They can't pierce that veil, so to speak, the trust veil, so they can't get to the assets inside the trust. And another reason would be, you often see rich moms and dads put money, property, into a trust for the benefit of their children. And then you've heard of trust babies, right? Like you've seen people, we joke about it, somebody who's, in their 30s, or, they're of a working age, but they're not working. And you wonder how they have all this money to buy boats and cars and go on fancy trips. And we call them a trust baby. And that's because their mom and dad, their parents, have created a trust for them whereby they enjoy income being distributed from the trust, but it's done in measured amounts to preserve the assets, which eventually will be inherited by the children upon the death of the parents. But they don't just want the kids to be able to spend money freely. They want it to be measured to some extent. So that's another non-tax reason for setting up a trust, is to help out the kids, but not to help them out so much that there's no preservation of the property. This is a pictorial to show you so that we can discuss some of the basic principles of fiduciary taxation. And again, trusts and estates are fiduciary entities. The first box, upper left-hand corner, says trusts and estates as separate taxpayers, and that simply means that they are considered to be tax-paying entities. So they file a form and they pay tax at their level. If they have taxable income. Now, in some cases, and we'll read and see about this later on in this chapter, some trusts actually distribute out as a requirement all of their income every year, so they would not be paying any income tax on their return, but they would still file a return to show the movement of the trust and the operation of the trust, income and expenses of the trust, if you will, during the year. The next box says no double taxation. And unlike a corporation, where a corporation gets taxed on its income, its net income, and then some of that income, some or all of that income, is taxed again once it's distributed out to the shareholders as a dividend, because then the dividend that's distributed is picked up in the income of the shareholders' return. And we just saw that with regard to our corporate return for AMI, the Alvin Sheet Music company, where they owned some shares in another corporation, and they received a dividend from that corporation, and now that dividend is taxable to them. But that $80,000 that was distributed to Alvin's company was also, there was tax paid on that by the distributing company as well, because it came from the net income of the company. So that's what the concept of double taxation means. Conversely, with trusts and estates, there is no concept of double taxation, because they receive a deduction for any income that they distribute to their beneficiaries. There's an actual line item on the return which will reduce their income by any amount that's distributed. So that avoids the consequence of double taxation. Conduit approach. This simply means that the distributed income in the hands of the beneficiary has the same character as it had to the trust. So an example of this is given in your book, where the Lopez Trust receives $15,000 of dividends and $10,000 of non-taxable interest, and it distributes all of its receipts to its beneficiary, who is deemed to receive $15,000 of dividend income and $10,000 of non-taxable interest. And the 15% tax rate applies to the dividends if the beneficiary's tax bracket exceeds 15%. However, the beneficiary has low adjusted gross income and taxable income, and if they do have low AGI and taxable income, and they're in the 15% or lower tax bracket, then the 0% tax rate will apply to the dividends. So that's actually an example to show you, number one, the conduit approach, how the character is deemed to, it takes on the same character at the beneficiary level as it does at the trust level. It's also to show you that the rules for individuals are similar, like for tax rates. In that example I just gave you, the 15% tax rate for dividends of an individual would be similar to how you would apply the rules at the trust level. This next slide shows a pictorial of the two accounting systems that we need to understand when we are talking about a trust. And one of those accounting systems is the fiduciary accounting system, or really the book system of accounting for the operations of the trust. And the other system is the tax system. So what we need to do is we need to understand whether items of income, or what we would think of as an item of income, or the actual property within the trust is going to be classified as principal or as income. Now the principal is sometimes called the corpus of the trust, and you could have a situation where you end up having certain income be income for fiduciary accounting purposes, i.e. book purposes, but it won't be income for tax purposes. So for instance, you could have interest on a state bond, which would be income for fiduciary accounting gross income purposes, but it would not be included in income for tax purposes. Now that's similar to what we've seen for individuals and for corporations. We know that interest on muni bonds or state bonds is non-taxable. There are also other kinds of items like capital gains, which are included in gross income, but they are segregated or classified as principal for fiduciary accounting purposes. So if a trust instrument says that the trust instrument is like the agreement. There are going to be rules under the trust that are established in what's called the trust agreement or the trust instrument. And if the trust instrument stipulates that the trustee can distribute only income prior to the termination of the trust, then there's going to be a ceiling on the amount of the distribution that can go out to the trust, that the trustee can pass out to the beneficiary, and that ceiling is going to be defined as fiduciary accounting income. So we need to understand that there are two separate systems that we need to calculate in order to determine number one, what the fiduciary income is, and number two, what the taxable income is. This is a pictorial which is also laid out in your book, but in a slightly different way. In your book, it's actually laid out in a box, in a blue-colored box called Topic Review C14-1, Classification of Receipts and Expenditures as Principal or Income under the Uniform Act of 2000. So you'll see that in the book, and then also in this pictorial in the slides, that your return from a principal asset, and what's a return from a principal asset? So if I put money in the bank and I earn interest on that, or I buy stock in another company and I earn dividends on that stock, that is my return from my investment. In the case of if I have an investment in a company where I receive stock, I give cash in exchange for stock, I've invested in that company, and my return on the investment is defined as the dividends I receive from the company. My return from an investment of cash into a bank account that earns interest would be the interest income that I earn. That's what they mean in this box here where they say current return from a principal asset. The principal asset would be like the stock that you hold in another company, or the cash that you hold in the bank account that's earning the interest. So that would be the principal. The income is the return that you get on that principal that you are holding in the trust. Same with regard to rent. Rent income is classified as income. So are interest and dividends. Whereas property that's held in trust for the beneficiary when the trust terminates is defined as principal or corpus of the trust. So are capital gain dividends. So capital gains are actually defined as corpus. They become part of the principal. And if you sell property, the capital gains or ordinary gains from the sale of the property are considered to be principal. Also, life insurance proceeds go to principal, the principal side. In your pictorial in the book, in your box in the book, it also segregates or classifies expenses of the trust as being either set against income or set against principal. So ordinary expenses like property taxes, insurance, interest, repairs, and so forth, and also income taxes, those expenses are reduced against, set off against income of the trust, like the rent, the interest, the dividends. Whereas expenditures like principal payments on debt and taxes that are assessed on gains from sales of property, those expenditures come out of the principal. They're set off against the principal of the trust. And this is important for us to know because depending upon how we classify the receipts and expenditures as either principal or income, it's going to help us to determine the taxability of the trust. So here's a formula for calculating taxable income and tax liability of a trust. You would start with gross income, and they tell you here that the same rules that you apply for individuals would be applied to the trust. Then you would reduce the gross income by deductions like interest, taxes, tax prep fees, all of those ordinary types of expenses that have to do with administering the trust. you would also subtract from there a distribution deduction. And that's the deduction that you get for your distribution from the trust. It gets a little tricky sometimes because the maximum amount of deduction that you get is referred to as your distributable net income, your DNI, minus your net tax-exempt income. So there ends up being several items that we have to calculate. We have to calculate fiduciary book income. We have to calculate taxable income using this formula. And then we also have to calculate DNI, distributable net income, because that's going to determine how much we can deduct as a distribution deduction from taxable income. So there are three things that we're having to calculate here. Then you also get an exemption deduction, kind of like the personal exemption that you get on a tax return. You get one on a trust return as well. The amount of the exemption depends upon whether you have a simple trust or a complex trust. You get a different exemption deduction. And then the result is your taxable income. So then you calculate your tax on your taxable income, and then you might have some credits to apply, and then your net tax liability is what would be due on your trust return. Before we move on to talk about what's pictured here on the next slide, which is these are basically compliance requirements, I do want to go through an example to show you the difference between accounting income, which is your fiduciary accounting income, which I told you is one of the three items you have to calculate, and then your gross income, which is what you calculate when you're coming up with the formula for calculating taxable income. So in the current year, Duke Trust receives $8,000 of interest from corporate bonds. Now a corporate bond, it's not a bond, it's not a municipal bond, right? It's a corporate bond. So for tax purposes, we would tax that interest because it's not tax-exempt interest unless it's coming from a municipal bond, a state bond, or a city bond. They also received $20,000 of interest on state bonds, so that is tax-exempt. And they also received $50,000 of capital gain. So for accounting income purposes, the accounting income would be $28,000, which is the sum of the $8,000 of interest on the corporate bond and the $20,000 of interest on the state bonds. Because tax-exempt interest is still considered to be included in accounting income or fiduciary accounting income, whereas a capital gain is not. It's considered to be part of principal. Because remember, I showed you on this last slide that capital gains are actually part of principal. I actually skipped that other slide. We'll go through that in a sec. And then for gross income purposes, which is for taxable purposes, the gross income would be comprised of the $8,000 of interest on the corporate bonds plus the $50,000 of capital gains. So the total gross income is $58,000, whereas the accounting income is only $28,000. So that's an example showing you of the difference between how you calculate fiduciary accounting income and gross income for tax purposes, for purposes of calculating the tax liability. I think the slide that I forgot to show you here is how you categorize the reductions from income for expenses that you incur. All of this is pictured in your topic review C14-1, the blue picture, the blue rectangle that I told you about when we were discussing income and expenses, but I must have somehow slipped past this slide. Trustees' compensation. So often trustees are paid compensation for taking care of the trust, administering the trust, half of their compensation is deemed to come out of principal, and half of it is deemed to come out of income. So you need to be careful there when you're actually calculating that deduction. However, when you're actually calculating your taxable income here, you would not take just 1/2 of the compensation. You should be able to take the whole amount. And so that's another little sticking point that you need to pay attention to when you're calculating taxable income, is to make sure you pick up that other half of the trustee's compensation. Now, a couple more things to be aware of that you might see in some of your homework problems next week when you're doing the homework for Chapter 14. Is one of the rules says that when you're calculating the expenses deductible on the fiduciary's return, costs of preparing the return, the tax prep fees, which would typically on an individual's return, they would be subject to a 2% floor, AGI floor. So those are called 2% deductions typically on a individual's return. So in other words, you would calculate the adjusted gross income of the individual, and then you would multiply it times 2%, and only tax prep fees in excess of that product, that 2% multiplied times AGI, are deductible as a Schedule A itemized deduction on an individual's return. When you're doing a fiduciary's return, you're not subject to that 2% floor. Also, the fiduciary is not subject to a limitation that's typically applied to an individual or a corporation on the amount of charitable contributions that are deductible. So remember that when you're doing your problems too. However, you are not allowed a deduction on the fiduciary's return unless the trust instrument authorizes a charitable contribution. So pay attention to that as well. This is just to show you the tax returns that would potentially be required of either a trust or an estate. So if you have an individual until his date of death, he would be preparing a 1040, and then you would use a 1041 to actually pay income tax on a trust. You would actually use a Form 706 to pay estate tax for an estate. So this is just to show you the different form numbers for the different types, the two different types of fiduciary entities, the estate and the trust. We already talked about the fact that gross income of a trust or estate is essentially the same for an individual as it is for a trust or estate. And also the fact that gross income for tax might not equal the income for fiduciary accounting purposes. And we walked through an example of that a minute ago. These are the different types of deductions that you're allowed for tax purposes. And we talked about how the trustee or the tax prep fees are not subject to the 2% floor, that you would be allowed a 100% deduction for the trustee's fee, whereas 50% of the trustee's fee comes out of principal and 50% comes out of the income side of the trust when you're calculating fiduciary accounting income. You would not have any limitation on your charitable contributions made. You might have some types of business expenses, and those are labeled as 162 expenses. You could have depreciation because you might hold depreciable assets within the trust. You might have some taxes that you would deduct because you paid state tax maybe in a prior year, or property taxes. And then you might have interest expense that you can deduct. We already talked about this. As I alluded to earlier, there are two different kinds of trusts. There are simple trusts and there are complex trusts. And one of the main differences between a simple trust and a complex trust is that for a simple trust, all of the income must be distributed each year. Whereas with a complex trust, you can accumulate income within the trust. You don't have to distribute it all each year. With a complex trust, you can also pay out of your principal. So you can distribute part of your principal each year out of a complex trust, whereas for a simple trust, you would just be distributing the income of the trust. For both a simple trust and a complex trust, your distribution deduction is limited to your distributable net income calculation that you would do, your DNI. But for a complex trust, your distribution deduction will be the sum of your required distribution under the trust instrument and any discretionary payments that are made during the year to beneficiaries. So those are the main differences between a simple trust and a complex trust. For an estate, there is a $600 per year exemption, personal exemption, that's accorded to the estate on its 706 return, on its return. And then for a trust, a simple trust is given a $300 exemption, and if and a $100 exemption if there's no requirement for annual distribution. And if there's no requirement for annual distribution, that would be defined as a complex trust. So they get a $100 exemption. For credits, the rules are similar for fiduciaries as they are for similar to the individual rules, the rules for individuals. And then foreign tax credits are limited to foreign taxes not allocable to the beneficiaries. So I don't know that any of our problems will go through that, but just something to keep in mind with regard to credits. This is just a pictorial to show you, because it is kind of goofy. I told you there's 3 different calculations that you have to do in order to hone in on what fiduciary accounting income is, what DNI is, and then what taxable income is. This is to show you that if you essentially calculate DNI first, and then you subtract from that your distribution deduction, your other expenses, and your personal exemption, that will equal taxable income. So that's kind of like a shortcut or another way of calculating taxable income. This is to show you that distributable net income is taxed partially to the fiduciary and partially to individuals. And there may be, in some cases, where both of them end up getting taxed, and that's because there's a limit on the amount of deduction that you can get for your distribution out to the individual beneficiary during the year from the fiduciary trust. So because there's a limitation, there may end up being, and whatever is distributed to the individual is then taxed to the individual, right? But I told you at the beginning of the chapter that there was no double taxation, but this is actually showing you that if you did have a limit on the amount of deduction that you got, you could end up with a little bit of overlap in the taxes paid by both entities. So here's another way of showing you a shortcut for determining taxable income for a simple trust. So it's your excess of gains over losses that are credited to principal, less your personal exemption, would be considered to be taxable income for the trust. Now, why did they say that? That's because you're going to get a deduction for everything. You get a distribution deduction for all of your income for a simple trust because it's required under the terms of the simple trust instrument to be distributed during the year. All of the income is required to be distributed. So that kind of wipes itself out. But if you end up having some gains in excess of losses, cap losses, let's say, credited to principal, because I told you that capital gains and losses, or capital gains rather, are credited to principal, those are not distributable by a simple trust because it's actually considered to be part of the principal, not part of the income of the trust. So it'll sit in the trust. However, I told you also that capital gains are taxable for tax purposes. So they're includable in gross income. So all you have to do if you're shortcutting this is to essentially say, what do I have that's taxable to, that's credited to principal, that is not distributable to beneficiaries as a simple trust? If I have any of that, all I can do then is reduce that by my personal exemption, and that's going to equal my taxable income. So that's your shortcut method. So what is the significance of DNI, distributable net income? It essentially sets a ceiling on the amount that's taxed to beneficiaries. So the beneficiaries are taxed on the lesser of the amount of distributions received or their share of DNI reduced by net tax-exempt income. So DNI, and also DNI determines the character of the beneficiary's income. So if the DNI is capital in nature to the fiduciary, to the trust, then it's also going to be capital in nature to the beneficiary. So that's the significance of DNI. So how do we calculate DNI? So taxable income exclusive of the distribution deduction, meaning before the distribution deduction, plus our personal, and then we add back to tax. So in other words, we calculate taxable income, but we exclude from taxable income whatever we think the distribution deduction is going to be, because remember, it's limited by DNI. So we would calculate taxable income before distribution deduction. Then we add back to taxable income the personal exemption we took, plus net tax-exempt interest, plus deductible capital losses. That, and then we subtract from that capital gains. That sum, or that end result, is going to equal DNI. So goofy, right? Now, allocating expenses to tax-exempt income. And let me just see where I am here in my book. I'm actually going to stop here, you guys, because I think this is a good breaking point. This is, I think the next bit of slides are actually covering determination of a simple trust taxable income, and then calculation of a complex trust income. That's objective 6. So I'm going to save that for my next lecture, and just be looking for that in the next couple days, and I'll talk to you guys soon.